inshallah khair. Now, what it says, now, capitalization, carrying amount, is it right? Which of the following should be capitalized in the initial carrying amount of an item of a plant? You tell me. You tell me, I am here to support you. You tell me right or wrong, nothing will happen. You are the only person, you are with me. Now, cost of transporting the plant to the factory. Is it cost of transportation the plant to the factory? Which of the following? Is it cost of transporting the plant to the factory? Cost of installing a new power supply required to operate a plant. Cost of 3-year plant maintenance agreement. Cost of 3-week training course for staff to operate the plant. Which one is that answer?
One and two. One and three.
Pardon?
1 and 3.
See, cost of transportation to the plant, what will happen? It will add to the plant value. Is it right? See, what is the capitalization? Capitalization means pre-operative. Is that pre-operative cost? Okay. This is pre-operative. Cost of installation also. It will add what? It will add value to the plant. Is it right? Next. Whereas this is what? Maintenance. Maintenance is the operating expenses. Is it right? Maintenance is the whereas cost of 3-week training is also what? Training is operating expenses. Answer is? Answer is?
1 and 2.
Good. Listen carefully. This is right?
Why the cost of 3 years plant maintenance agreement we will not add it because of the 3 years will be يعني?
It is every operating cost. After plant is purchased, is it right? After purchase. Is it? After purchase, these are expenses. Is it right?
Okay.
When we will take the things into consideration, we have to take into consideration expenses before or till it starts. It is till it starts beginning. Once you have started using the plant, other expenses will be operating expenses. Okay, other expenses will be we should capitalization. This is what is when you do the things. Good, I will tell you. When you do the things, is it right? Expenses will be divided under two different things. One is capitalization, capital expenses. One is revenue expenses. You call it as a revenue expenses or you call it as a operating expenses. Is it right? You call it as a revenue expenses or you call it as a operating expenses. Is it? These two are capital expenses. These two are operating expenses. Is it okay with you?
Yes, it's okay.
Yes, good. When a parent, what they are asking, when a parent is evaluating the assets of a subsidiary, certain intangible assets can be recognized separately from goodwill, even though they have not been recognized in the financial statements of the subsidiary. Means when you are evaluating the assets of the subsidiary, certain intangible assets, some intangible assets are there which are not is part of goodwill. What is not on part of goodwill? It is not in part of goodwill in terms of maybe assume patents, it will be copyrights, is it right? It will be copyrights, it will be It will be good not patents, copyrights and trademarks. Is it right? No. What they are saying, which of the following is an example of an intangible asset of the subsidiary which is recognized separately from goodwill when preparing which one is the intangible assets? Is it? We have to now what is the intangible asset? Intangible asset is nothing but is it right? Which should generate revenue for the company. Is it right? Now, what are the things are they? Is it which is not which is apart from goodwill? Is it right? Which may be recognized separately from goodwill. Okay. A new research, it should be related to the entity. Okay, it should be related to the entity, it should be related to the firm, and it should generate profits. Okay, revenue. Okay, a new research project which is subsidiary has correctly expensed to profit and loss account, but the directors of the parent have reliably assessed to have a substantially fair value. Okay. A global advertising campaign which was concluded in the previous financial year and from which benefits are expected to flow in the future. Is it right? See, advertising campaign is an expense. Is it right? It is an expense. It is not an asset. Is it right? It is a expense. Is it? It is an operating expense. Intangible assets means it should have some value. Is it right? It should have some value as such. It is an expense. A contingent liability. Contingent, see the moment contingent asset. When you say contingent asset, is it right? When you are talking in terms of a contingency, maybe or may not be. Okay, maybe or may not. See, it is not certain. By name itself says a contingent asset is a subsidiary from which the parent believes a flow of economic is possible. No, it's not a possible. It should happen. Is it right? It should happen. Intangible asset means the revenue should happen. Is it right? Revenue must happen. I can say. Must happen. Is it right? Again, it is not. It is also not the case. Is it right? It is also not the case. This is a customer list which has the directors is unable to bear. This is the customer list. This is not belong to the entity. Is it right? It is the customer list with the directors are unable to value. Is it right? You have the customers list with you. Another thing is right. Internally, the rule says that internally generated, if remember this, internally generated should not be treated as a intangible asset. This is the condition. Okay, this is the condition of the intangible asset. Intangible asset means it should be purchased. Is that? This is also not there. What is the option available? A new research project which the subsidiary has correctly expensed to where profit and loss account. Is that? But the directors of the are reliably assessed to have it has some value. Is it right? It has some substantially fair value. Its intangible assets should have substantially fair value as such. Okay. Point number A. Fine. Now you will understand. You will find it more easy also. Is it? Your confidence should build up. That is very important. Is it okay with you?
Yes, it's okay.
On 1st October 2004, Flash acquired an item of plant under lease. We are talking in terms of lease, okay? We are talking in terms under the terms of the agreement. And immediately, how much they have deposited? They have deposited 2 million. Okay, they have deposited how much? 2 million. is payable on inception of the lease and the present value of future lease payment at that date has been calculated how much 25,272. This is the present value of future lease payments. How much is the annual rental? 6 million. Okay, definitely how many it is for 5 years. Now, what they have given you the interest of how much? 5%. Means how much they are paying? 6 million they are paying. Is it? 25 million is the total value. Okay. What is the rate of interest? 5%. Is it right? Now, what they are asking you? What is the current liability? Is it right? What is the current liability? How we have to do? Any idea? First you have to write year. Is it right? You have to write year. You have to write an opening balance. Is it right? You have to take opening balance. You have to take interest at the rate of 5%. Okay? Interest. Then you have to take payment. Is that very simple? Is that? Then you have to take closing balance. Fine? Put that dash. Fine? Now, year is, when we are talking about, year is 30th September. What is the condition of current liability? Current liability is of at the year end, next 12 months, the amount which is going to be payable for that 12 months, that is the current liability to be shown. Okay. This is 30th September 2005. What is the opening balance? Opening balance is 25,272. Okay, how much is that? 25. What is the interest on this? Calculate. How much is the interest? 25,272 into 1.0 into 5 by 100. 25,272 into 5 by 100. How much you will get? Twenty-five to 72 into 0.05. 1263600. How much? 1263600. Is it okay? Is it fine?
Yes, it's fine.
Next, how much is the payment? 6 million. Is it right? How much is the payment? 6 million. What is the formula? This is column 1, this is column 2, this is column 3, this is column 4. Column 5 is how? Column 5 is 2 plus 3 minus 5, 4. Is that 2 plus 3 minus 4? 25,272 plus 126,360 minus 6 million. It comes to how much? It comes to 205,35600. Is it okay? Fine. This is the current year. Okay. This is the current year. Now we have to take what is the next year. Is it right? We have to take, unless until we don't calculate the next year, we cannot assume 30th September 2006. Okay. Opening balance will be how much? Opening balance is the last year closing balance. 535,600. Is that 535,600? what 25, 35, 600 into 5 by 100? How much is there? 25, 35, 600 times 0.5. It comes to how much? 10, 25, 35, 600 into 0.05. 10,
02102670.
okay, 1 minute. Twenty 535 600.05 1026,780. Is it right?
Yes, it's right.
Is it right? How much is there? 6 million. Fine. How much is there? 6 million. What is the how much you get? 25, 35, 600 plus 1026,780 minus 6 million. How much is there? 155
155,62380.
38. Fine. Now, what is the current liability here? How much is the current liability? How much is the current liability? How we calculate current liability?
We will take the difference from
Good.
closing balance.
Alhamdulillah. Difference. How much is the difference?
4973
49
220.
25 35 600 minus 15 562 380 497
3220.
3220. This is what? This is the current liability. 497 3220. Is it okay?
Yes, it's okay.
Fine. Financial statement represents transactions in words and numbers to be useful. This is lecture 7, okay? To be useful, financial information must represent faithfully these transactions in terms of how they are reported. Means financial transactions talks about what? It talks about words and numbers. To be useful, it should be represent faithfully in terms how they are reported. Identify by selecting the relevant box in the table below whether the statements are faithful representation, true and false. Okay, now charging see if it is given like this, each one will be how much? Each one will be 5.5 marks. Okay, 0.5, 2 marks is there. Is it right? Charging the rental payment for an item or plant to the statement of profit and loss account where the rental agreement reads the criteria for lease and no recognition exemptions are available. Now, what you are doing, see, charging the rental payment. Rent is different, lease is different. Okay, rent is different, lease is different. Is it? What they have done? They have charging the rental payments. Okay, for the plant and machinery to the profit and loss account. Fine. Where the rental payment meets the criteria of lease and no recognition exemptions are available. No, when you are talking about rental payment, focus on rental payments only. You cannot mix rental payment with the lease payment. Criteria is matching fine, but the concept of rental is different, the concept of lease is different. In the lease payments, we will add the interest, whereas in the rental payment, there is nothing like interest. Okay, there is nothing like present value. You pay rental, it is done for the day. Answer is true or false? Rental payment is related to rent. Okay, it is a operating expenses, whereas lease is different. Is it? You cannot put lease mix up with the rental payment. Fine, you will never do that. Is it? Lease is different, rental payments are different. That is the reason I am putting different colors also. Is it right? The answer is what? The answer is false. Okay. Is it okay? Clear?
Yes, it's clear.
Including a convertible loan in equity on the basis that the holders are likely to choose the equity option on conversion. Including a convertible loan note in equity. You cannot see what happens when you are talking about convertible loan. Is that convertible loan? They will say 5% convertible loan to equity. This is financial statements presentation. Okay, the financial instruments. Okay, financial instruments. They say convertible to equity of. Is it? Now you have to show it separately. Is it right? You have to show it separately. You should not include it after conversion. Is that? After conversion it can be included. Is that? After conversion it can be included, but you should not include it, and we should not loan in equity on the basis. On basis is fine. Is that? The holders are likely to choose. No, it is not likely to choose. Is that? It's a convertible means after 5 years, automatically it will be converted to equity. Is it right? You will not have any options are there. Is it right? You don't have any options are there. Fine. Here they cannot choose it. Is that? They have to make it a point of undertaking. Answer is what? False. Is it okay? Understand? Just make treating redeemable preference shares as part of equity in the state. No, we cannot. See, redeemable preference shares are different. Is it right? Redeemable preference shares are different. Equity is different. Is it right? Redeemable preference shares are different. You cannot say it is a part of equity. Redeemable preference shares means what happens? See, when you talk about the redeemable preference shares, is it right? When you are talking about the redeemable preference shares, what happens? 10 years. Is it 10 years redeemable preference shares? Redeemable preference shares will be redeemed again to preference shares only. There is big difference between a preference shares and the equity shares. Big difference is that preference shares will have preference over the dividends compared to equity. Okay, is that now you cannot treat it as a part of equity. Fine, it is also false. Now, can I go to the next one?
Yes.
De-recognizing. Take your time. Okay, take your time. That's very, because we are doing the things across the exam. It is like an examination. Is it right? It is like an examination. You have to. Little bit challenging because you have to cover so many topics at once, and it is the good exercise what we are doing. Good exercise. De-recognizing factor trade receivables sold without recourse to the seller. Is that what? First you have to say what is the recourse and what is the non-recourse. Is it right? See what happens. Is it right? What happens? The things it says that. Is that you have the receivables. Is it right? You have receivables. Now receivables are for how many days? 90 days. Now what happens if it is not recovered within 90 days? Is it right? It is not recovered within 90. Is that what it is not recovered within 90 days? Again, what they will do? They will give back to whom? They give back to without recourse means they give back to the seller. With recourse, see, without recourse, is that, see the things how it will work. I will put here, is it right? I will put this as, I will put this as here. Okay, is that with recourse? Is it with recourse and without recourse? With recourse, you will take the responsibility. Is it right? You will take the responsibility. Yes, the commission will be more. The amount will be, risk will be less. Is it? Without recourse, what they will do? If there is nothing happening, definitely you have taken from me receivables. I sold my receivables. When I sold my receivables, 90 days. 90 days, you are a bank. Is it? Assume you are a bank. You have taken my risk. I take my money. It is for 100 riyals. You have given me 90 riyals. Fine. Now after 90 days, if you are not recovering my 100 riyals, what you will do? You will return back to me. Okay. You will return back to me, and I will have to pay my 100 riyals to you. Is it right? Means you are going to sell it back. We are de-recognizing. What you are doing in this process? This is the key word, is it right? What you are doing in this process? You are de-recognizing. You are reversing. Is it right? What you are doing? You are making the reverse. Otherwise, you are cancelling. In simple words. But in accounting, we don't use these words. Is it right? The answer is what? True or false?
False.
True. Without what we are doing? De-recognizing. Means what I told you. I have given 100 riyals. Is it right? Receivables of mine to the bank. Bank will take 90 days. When after 90 days, if my receivables are not going to be recovered by the bank, what the bank will do? Bank will de-recognize me, means they will return back to me and they will get back they back whatever the amount has been given, guaranteed amount, they will take back the guaranteed amount. Or in other words, they will take the commission as well as they will take the principal amount. It is a without recourse means there is no carry forward as such. Are you clear about this?
Yes.
Little bit, okay? Just we will do. The moment we try to do, we will find it. On October 1st, Kalatra commenced drilling for oil, undersea oil field. Is it right? Kalatra is required to dismantle the drilling equipment at the end of its 5-year license. Is it right? They have estimated a cost of 30 million on 30th September. Kalatra cost of capital is 8% and $1 5 years time present value is how much? 68 cents. Select your answer from pull down list to identify the provision which should be then in the financial statement as on 30th September in respect of its oil operations. When we are talking about oil, it is for the 30th September 2005. How much amount they have? See what they are saying. Commence drilling, fine. There is a dismantled of drilling at the end of 5 years. How much they have the dismantle? 30 million. Fine. What is the cost of capital? 8%. What is the present value? 68.68. Is it right? First you have to calculate the present value of dismantling cost. Okay, present value of dismantling cost we have to calculate. How much is the present value of the dismantling cost? Present value of dismantling cost. Is it right? Is it estimated cost? Is it right? Estimated cost times present value of dollar at the rate of 8% of for 5 years. Is it for 5 years? Estimated cost is how much? 30 million. Okay, times 0.68. It comes to how much? 30 million into 0.68.
20.4.
It comes to how much? 20.4 million. Is it right? 20.4 million. Fine. 20.4. Is it right? No. What they say, Kataria cost of capital, drilling 5 machines. The cost of capital is how much? 8%. Is it right? Add. Is it right? Add interest. Add interest at the rate of 8%. At the rate of 8%. How much is there? How much is there? How much is there? 20.4 times 0.08. It comes to how much?
1.632.
1.632. Total is how much? 23012. No, 22.
22.032.
22.032. How much is the answer? How much is the answer? 20.22032. Is it okay?
Yes.
When a single entity makes purchases or sale in foreign currency, it will be necessary to translate the transaction into a functional currency before the transaction can be included in finance. In accordance with IAS 21, the effect of changes in foreign currency rates is it which of the following currency rates may be used to translate foreign currency purchases and sales? Now, where we have done this, where is the foreign currency? Foreign currency is here. Is it right? Foreign currency. What is the rules of foreign currency? Is it right? Exchange rates. Is it right? Exchange rates. We have taken the historical rate. Is it right? See, we have taken the historical exchange rate. Is it? This is the historical rate in place at the date of transaction takes place. Is right? So, or sometimes referred to as spot rate. Closing date reported on the reporting date. Average rate throughout the accounting period. This is the conditions. Okay. Now coming to the point, where is that? Where is our mock exam here? What they are saying? They are talking in terms of purchase, make purchase or sale in the foreign currency. It is throughout the year. Is it right? It is throughout the year. If it is throughout the year, then we should not take the spot rate, or we are not take the other rate. We have to take which rate? We have to take the average rate. Is that we have to take the rate which exists on the date of purchase or sales took place. Fine. We should not the rate which exists beginning of the period. No, we will never take into consideration beginning of the period. Okay, we will never take into beginning because it happens throughout the year. An average rate, is it right? An average rate for the year. There have been no significant fluctuations throughout the year. The rate which exists at the end, no. We will not take beginning whenever there is a purchase. Is it? Whenever there is, I will write here, whenever throughout the year, whenever there is a purchase or whenever there is a sales, it is going to be taken as a average rate. Is it right? It is going to be taken as a answer is what? Tell me, right or wrong, nothing will happen.
3.
Huh?
1 and 3.
Good. I will give you time to make you think, okay? 1 and Next. On 1st October 2004, High Company had 2.5% million equity shares. Okay, fine. No new shares were issued during the year. Is it right? 30th September. What they are asking you? They are asking you to calculate earning per share. What is the diluted earning per share? Okay, what is the diluted earning on? Okay, fine. How many shares are there? They have the shares of 2.5 million. Okay, 2.5 million equity capital. 2.5 divided by 0.5, is it right? 2.5 into divided by 0.5. How many shares? So fine, okay. Okay, just keep like that. Okay, 1 minute. Is it? We'll come to this. No new shares were issued. Is it right? No new shares were issued during the year. But on the date there was outstanding share options which had a dilutive effect equivalent of issuing how many shares? 1.2 million shares for no consideration. Means there is nothing we are going to work it out. Is it right? How much is the profit after tax? 1,550. Okay. First, you see what is the EPS? EPS is nothing but profit after tax divided by number of shares. Okay. Now, opening number of shares are opening shares are how much? Opening shares are 2.5 million divided by 0.5 per share. It comes to how much? It comes to how much? 2.5 divided by point. It comes to how much? It comes to 5,000 shares. Is it right? It comes to how much? It comes to 5,000 in thousands. Okay, in thousands. Add. Is it right? Add new diluted shares. How much is there? Add new diluted shares. Add new diluted shares. How much? 1,200. 6,200. Okay, 6,200. What now? You put the thing. 1,550. Is it 1,550 divided by 6,200?
0.25.
0.25. Next, Ford company owns 80% of investment in Spoon, which has purchased several years ago. The goodwill on acquisition is this much, and there was no impairment to the goodwill since the date of acquisition. On 30th September 2004, Ford company disposed its entire investments. Sale how much? This much. Is it? They have see what are the? This is the parent company. This is the subsidiary company. How much is the parent company? 80%. Subsidiary company is how much? 20%. Is it right? There was a goodwill. Is it right? There was a goodwill. Goodwill is not impaired. 1674. Okay, 1674. Fine. Okay. Now they have sold it. How much they have sold it? 5,550. Cost is how much? Cost is 3,720. Cost of fork investment in the beginning. Immediately before the disposal, the consolidated include the following amounts. Is it right? Net carrying amount of the net assets how much? Good. 4464. Goodwill is carrying amount of non-controlling interest is how much? Is it right? Fine. Now, fine. Okay. Goodwill is how much? Goodwill is 1064. What is the profit on disposal before tax will be recorded? How you have to do profit before profit or loss on disposal? First you have to take sale proceeds. Okay, from the sale proceeds, what you have to do? We have to remove. Is it right? We have to remove what? We have to deduct. We have to deduct the net assets of disposal. Sales minus net assets of disposal. You have the goodwill is there. Definitely when you are removing the things, we have to remove the goodwill also. And from the goodwill you have to take out the carrying value of the non-NCI. Is it right? We are not concerned about this value. Is it right? This value is outdated. Is it right? This value is not required. Is it right? This value is not required at all. It is the thing. First you have to take sale proceeds. Then you have to take what is the carrying amount of net goodwill, net assets, excluding goodwill. Then you have to take goodwill. You will get the things. Is it right? Then we have to think about the NCI. NCI you have to deduct it from the carrying amount. Fine. Now, slowly I will write here. Okay, I will write here sale proceeds. How much is the sale proceeds? In thousands. Okay, in thousands. How much is the sales proceed? 5,580. Okay, 5,580. From this sale proceeds, is it right? From this sales profit, we have to see this is A. Is it right? This is A. You put like this, it will be easy. Last time we have done like this, if you remember. Okay, you have remember last time we have done. Now net assets. Net assets at disposal. Is it right? Net assets at disposal. How much is the net assets? 4,464. Okay. Next, add goodwill. Add goodwill. How much is the goodwill? 1,674. Is it right? How much will get? 8, 3, 1, 11, 1, 10, 1, 6, 1, 3, 8. Okay. From this you have to remove NCI. Is it right? NCI, non-controlling interest. Non-controlling interest is how much? 900. 8, 3, 8, 3, 11 minus 9, 2, and how much? 5. This is the B. Is it right? This is the B. What is the profit? Profit or loss? Profit or loss is nothing but A minus B. Okay, A minus B. 5,580 minus 5,238. How much is the amount you'll get?
342.
342 thousands. Is it okay?
Yes.
Next. See, now you can understand the exam pattern. Okay, this is the exam pattern. They will give theory, they will give calculation. They will give theory, they will give calculations. Is it right? Next. Consolidated financial statements are presented on the basis of companies within the group are treated as if they are single entity, economic entity. Fine, good. Which two of the requirements are preparing consolidated financial statements? Is it right? Now you tell me. Tell me which one we have to, which two we have to take. Any idea? Yes or no?
A. All subsidiaries must be adopted accounting policies.
All subsidiaries must adopt the accounting policies of the parent in their see, there is no condition. There is, see, must is not there. Is it? See, accounting is lot of, see, accounting is based on the assumptions. Is it right? Accounting is based on the assumption. You should never use must. Is it right? You should never use, all subsidiaries must adopt. See, parent company is different, subsidiary company is different. Is it right? See, parent company is in automobiles. Is it right? Assume that parent company. Subsidiary company, is it right? Subsidiary company will be in tourism. Is it? Is it? There's no link. There's no. You cannot say that I will only buy automobile. No. Is that it's up to you. All subsidiary must adopt the accounting policies of the parent in their individual financial statements. It is not. Fine. Subsidiaries with activities which are substantially different to the activities of the member should not be consolidated. No. Is that there's nothing, there is no hard and fast rule that you have to buy only automobiles. No, you have, see, Twitter, you see the Twitter is bought by Elon Musk. Is that one side he is having electric cars, the second side he is having a telecommunication, social media. Is it right? There are two different things, but he consolidates. When you are consolidating, you will not see which one is there. You will consolidate it, plant and machinery to plant and machinery, cash to cash, receivables to receivables, payables to payables. Is it right? So there should not, the other members of the group should not be consolidated. No. All entity financials within the group should normally be prepared. Normally, is it right? Be prepared to the same accounting year prior to consolidation. We are not going to change anything. Is it right? We are not going to change anything. Unrealized profits within the group must be eliminated. We have done this now. Provision for unrealized profits. If there is any unrealized profits, those profits, what we have done? We have eliminated. We have eliminated. Okay. Is it okay?
Yes, it's okay.
What I understand is if you calculations you will understand very quickly. Is that in theory it's taking time. Okay, no problem. Inshallah, it will happen. Is it right now? Okay, dashing group sells goods to its 80% owned subsidiary. Okay, 80% owned subsidiary. Dancer company during the financial year, some of which remains in inventory at the year end. Fine. Using a drag and drop option, select the correct adjustment required in the consolidated financial to eliminate any unrealized profit. Is it? Eliminate unrealized profit. First, you should know what happens if there are profits. Is it? First, you should know original entry. If profits are there, credit will be what? Credit will be retained earnings. Is it? Credit will be retained earnings. Debit will be what? Debit will be inventory or purchases. Is it right? Inventory or purchase. Fine. Once you are eliminating, is it right? Eliminating means this will go up, this will go down. This will become debit, is it right? This will become debit and this will become credit. Is it right? Debit will be what? Debit will be group retained earnings. Credit will be what? Credit will be inventory. Is it right? Because see what happening, you see what in you when you are doing the things, sell goods 80%, is it right? During the financial, which remains in inventory. Is it? Which remains in the moment it is remains in inventory, definitely is it right? It means it is a intergroup transaction. Is it right? It is a intergroup transaction. They are saying that you have to eliminate this transaction. As simple as that. Is it right? Is it right? You have to eliminate. Now when you are eliminating the transactions, what will happen? What we have to do? We have to retain earnings. We have to decrease. Is it right? Is it? Retain earnings we have to decrease. Next, where what happening? We are talking in terms of inventory. Is it? One minute. It is not. It is should be like this. Is it? If it is done, if it is in the original entry, what will happen? Retain profits will be there. Profits will increase and inventory will decrease. Okay, this is the original entry. Now if it is a reversal, what will happen? Retained earnings will decrease. If you want to decrease it, it should be debited. And inventory is not sold. Is it right? Inventory is not sold. Inventory has to increase. When inventory has to debit inventory, cost of goods sold. Is it right? The inventory is otherwise called as a cost of goods sold. Okay, cost of goods sold, the debit, and inventory is credit. Is it right? Now we are reversing it. When we are reversing it, what will happen? The retained earnings has to decrease. When retained earnings has to decrease, it will be debit. Is it right? And inventory has to is it cost of goods sold. Is it right? They should have used cost of goods sold. It will make more simple. Is it right? Cost of goods sold. It has to, we have, yeah. I have written so many things here. That is the reason. Is it right? That is the reason. 1 minute. 1 minute. Here it is inventory. Okay. It is inventory. Inventory is nothing but it has a cost of goods sold. Is it right? Now, when you are doing the inventory, it should be reversed. Is it right? You have the cost of goods sold has to be reversed. Is it right? When you have to cost of goods sold has to be reversed. We have done here what? We have done debit. Is it right? In order to make it a reversal, what we are doing? We are taking the cost of goods sold as a credit. Again, I will explain you. First, you have to understand the original entry. Original entry, how it happens? Original entry is it is you got the profit. Is it that unrealized profit? Is that original entry says that cost of goods sold or inventory will be debit as we have earned the profit. Is it during some of the goods remained in the inventory. Fine. Using the drag approach, you have to eliminate the unrealized profit. If there is a profit, we will take retained profit as a credit. Is it right? If there is a profit, we take a retained profit as a credit. But if you want to eliminate, is it right? If you want to eliminate, what we have to do? We have to make retained profit as debit, and cost of goods sold is an expense. Is it? Debit all expenses and losses. Debit all expenses and losses. Now, in order to make it a reversal, debit has to be done with respect to what? Credit. Is it? Here what will happen? Debit will be group retained earnings, and credit will be what? Credit will be inventory. We will not have anything related to non-controlling interest. Just revise it. If it is clear, I will go to the next one.
It's clear.
Next. What it says, Caddy acquired 24 to 40 thousands of Amble equity shares. Is it right? Campbell equity shares. For how much? 6%. Is it right? How much they have acquired? They have acquired is how much? 240 shares into $6. It comes to how much? It comes to 1, 2, 3, 6 fours are 24, 2, 6 twos are 12, 14. Okay, how much they have? This is the cost of investment. Is it right? This is the cost of investment. Now, Ambil profit is how much? 400,000. Is it? Ambil profit is how much? 400,000. And it paid an equity dividend of how much? 150,000. Is it right? And it paid equity dividends of how much? How much they have bought it? They have bought it 240,000. Is it right? They have bought it for 240,000. See, 240 divided by 800 is how much? It is how much? It is how much? 30%. Is it right? It is how much? 30. If it is 30%, it is going to be identified as an associate. It is identified as an associate. Okay. How much they have? 140. Now, how much is the profit they have? 400,000. How much is the dividends? 150. On the assumption that Amble is an associate of Caddy company, what would be the carrying amount of investments in the consolidated financial statements? We will take, this is the cost. Is it right? This is the cost. 1 minute. I will write neatly. 1 second. 1 second. Is it? Cost of investment. You have to write this, okay? We are not writing, but you should understand this 30%. Is it right? If it is in section C, we will do cost of investment 240,000 into 6. It comes to how much? It comes to 1440. Is it right? Next, add. Is it right? Share of associate profit. Is it right? Share of associate profit. How much is share of associate profit? 400,000. 400,000 times 30%. Okay, 30%. It comes to how much? 120,000. Is it? Share of dividends also. Is it right? You have the share of dividends. Is it? How much is the dividends? 150,000 into 0.30. It comes to how much? 45,000. Total how much? 0, 0, 0, 5, 2, 4, 6, 10, 1, 6, 1. One minute, 1 minute. One minute. Cost of investment is how much? Cost of investment is 1,440. Share of associate profit is how much? 100. Now, when you see what we have done, when you pay dividend, is it right? When you pay dividend, is it right? What will happen? Your profits will decrease. Is that when you pay dividends, profits will decrease. Fine. How much is the this we have to less? We have added as simple as that. Less dividends. Is it less dividends in associates? Profits will decrease. Is it at 120? 120 into 0.3. It comes to how much? It's not 120. It is 150. Is it 150 into 0? It comes to how much? 45,000. How much you'll get? One four four zero plus 120 minus 45. Is it right? 1515. Take your time and think. Okay. I'll just give some time to understand. Any doubt, you ask me. Is it clear?
Yes, it's clear.
Next. Again, a theory question. Is it right? Quartile company is a jewelry retail business which can be assumed to be highly seasonal. For the year ended 30th September, Quartile will assess the operating performance by comparing selected accounting ratios. This is the ratio analysis, okay? Ratio analysis. We'll see. I will explain, no problem. With those of its business sector average as provided by the agency. Assume that the business sector used by the agency is a meaningful representation sorry, of quartile company business. Which two of the following circumstances may invalidate the comparison of quartile? I will tell you this later. Is it right? I will tell you this later. In the current year, Quartile has experienced significant rising cost for the purchase. Which two of the following may invalidate the comparison of ratios with the sector's average? Is it right? In the current year, quartile has experienced significant. Just you hold it, okay? Just you remind me, okay? Just you remind me. Once we have done ratio analysis, we will do this, okay? Just you remind me. Is that we should have done ratio analysis. Without that, we cannot work it out, okay? Which of the following for which of the following criticism does not apply to historical cost financial statement during the rising prices? Which of the following does not apply? Is it right? Does not apply. They are difficult to verify because transactions could happen many years ago. Which of the following criticism does not apply? Means criticism means limitations. Okay, criticism means accusation that limitation. They are difficult to verify because transactions could have happened many years ago. They contain mixed values. Some items at current values and some are out of date values. They understate assets and overstate profits. They overstate gearing in the statement of financial position. They are difficult to verify because which of the following criticism does not apply to historical cost financial statements? Is it right? Historical cost which does not apply. They are difficult to verify because transactions could have happened many years. They contain mixed values. Some items are at current values, some items are at out of date value. They understate assets and overstate profit. They overstate gearing in the statement of. See what happens. It applies first. Which of the following? Which are the limitations of inflation accounting? It is like this. Is it right? Which are the limitations? Which of the does not apply to history? Which are the limitations of inflation accounting? They are difficult to verify because transactions could have happened many years ago. They contain mixed values. Some are at current values and some are at out of date values. They understate assets and overstate profits. Is it? They understate assets and they overstate profits. Fine. They overstate gearing. See which of the following criticism does not apply to historical cost financial statements. Which not it applies? No, fine. See they contain mixed values. It applies, is right? It means what happens if the prices are increasing, prices are decreasing. Is it right? If prices are increasing, prices are decreasing. What is first little bit we have to understand what is the inflation accounting. Is that what is the inflation accounting and what is the historical accounting? Is right? This is the base. In historical accounting, it is the past cost. Okay, it is the past cost. Whereas inflation accounting, it is the rising prices. Is it right? It is the rising prices. Now, which is not applied to historical cost. Is it right? Which is not applied to historical cost. And that's what which of the following criticism does not apply to historical cost. They contain mixed values. Is it that some are current values, some are out of no. See, historical cost is past values only. Is it right? Historical cost is only the past values only. Is it right? This does not apply. Is it? No. They are difficult to verify because transactions could have happened many years ago. Is it? Which of the following does not apply? See, historical cost says that it is the past transactions. Is it right? Historical cost says it is the past. They are difficult to verify because what happens? Historical cost transactions could have happened many years ago. You have bought it what? You have bought it in the year 2015. Is that you have bought it in the year 2015 property and plant equipment for how much? 20,000 reals. Is it right? This happened somewhere 2015. Inflation accounting is the current prices. If there is a inflation accounting, what will happen? It will take into consideration mixed values. Is that mixed values? Opening value, closing values. If because of mixed values, what will happen? Some assets. See, one asset has been purchased in 2005, 20,000. Okay. Another asset has been purchased in 2019. Same asset, but the value is how much? Value is 25,000. The same asset has purchased. Is it right? It comes to how much? 29,000. This is what the inflation accounting. Prices are rising. Is it right? If prices are rising, you what will happen? Sometimes your assets are 20,000 was the asset. Now the same asset is how much? 29,000. But what will happen? You will group it, all the things, based on the historical cost, but not based on the inflation accounting. What will happen in that case? You will show less value of assets in the asset side. Automatically, what will happen? If assets are understated, is it right? If the assets are understated, automatically what will happen? Depreciation will also be less. If the depreciation is less, what will happen? The profits will be more. It is a criticism. It is a criticism with respect to what? With respect to the inflation accounting, but not with respect to the historical account. They overstate gearing in the statement of financial position. What happens? See the things. Is that you have the loan. Is it right? You have the loan. You have taken the loan of 20,000. When you have taken the loan of 20,000, 2016, You have taken a loan of 26,000. Is it right? You have taken the loan of 26,000. When you have taken loan, you have taken loan of in year 2021. What will happen? Is it what will happen? The concept is if we have to take into consideration the time value of money. But are we taking the time value of money? No, we are not taking the time value of money. Is it? When it doesn't take into time value of money, it doesn't apply to historical cost accounting also. Little bit thinking question. Is it a little bit thinking question? Means if what they say gearing is nothing but the debt divided by debt plus equity. Fine. Debt divided by debt by equity will be on the historical cost. Is it right? Historical cost. See, 20 years back you have issued equity capital. Still the equity capital will remain same in the balance sheet. Okay, in the balance sheet it will remain same. It will never change. Now what happens if you're doing that? Is it that? If you are doing that, the concept is how it is reflected. How it is reflected in the financial statements. You have taken equity capital 2016, same thing will be happen. Now you are taken the loan. Is it right? Gearing means you are taking the loan also. We are comparing loan with the equity. Loan we have taken 20,000 last year. This year how much taken? 26,000. Historical cost says that we should never ever change the values. But inflation accounting says that it has to be presented in the current purchasing power values. If that is the case, the loan amount will be overstated. Is it right? The loan amount will be overstated. 20,000. See, value of the loan. Is it right? Value of the loan will be comparatively high because the time value of money. Value of money will increase. Sorry, time value of money will decrease as per inflation accounting, whereas as per the historical accounting, the value of money will remain same. If that is the case, the gearing ratio will be overstated. Means you are showing more than its actual amount. Is it? The answer is A. It means how we are going to work it out with respect to the items in terms of the current values, in terms of the assets, and in terms of the liabilities. Is it okay?
Yes.
Little bit I can understand. It takes time to understand, that's all. Is that it? Takes little bit time to understand that, no, not more than that. Okay? Fine. What it says, the following information has taken on calculated from the flowers financial statements. Cash 70 days. This is ratio analysis. Okay, fine. This is straightforward question. Okay, this is straightforward question. This is not that much difficult. Okay. Anyhow, I will by the time we will explain, I will explain you as I am explaining for the first time. Okay, don't worry about that. You have the cash. How many days the cash is? It will take 70 days. Okay. Year-end inventory. Inventory is taking how many days to convert it into cost of sales? 6 times. Is it right? Inventory means yearly how many times taking? It will be taken 6 times to convert into cost of sales. Is a year end trade payables. How much is there? 230. Credit purchases. How much is there? 2 million. Cost of sales is how much? 18 million. What is the receivables collection period? Is it right? What is the receivables collection period? Fine. Now, receivables collection period is cash cycle. This is the formula, okay, minus inventory turnover days, cash cycle days minus inventory turnover plus payables. Yeah, plus payables. Fine. Now cash cycle is how many days? 70 days. They have given. Is it right? Cash given. Now, what is the inventory? First time we are doing, okay, ratio analysis. The formula for inventory turnover is that the formula for inventory turnover is number of days in a year divided by inventory. This is inventory turnover days. Is it inventory turnover in terms of times. 365 divided by 6. Is that 365 divided by 6? How much you will get? How much you will get? 6 are 60. So almost 61 days. Okay, how much? 61 days. Fine. Yes. How much? 61 days minus 61 days. Fine. Next, payables. Is it right? Payables. How much is the payables? Payables is how much? 230. Is it right? Is it year end payables? Payable days. Is it right? Payable days is nothing but year end payables. Year end payables times. Is it right? Is year end payables times year end payables times year end payables cost of sales 1.8, credit purchases 2 million. Is that credit purchases 2 million? See, from where payables will come? Payables will come from credit purchases. Is it right? Payables will come from credit purchases. Payables times number of days. Payables times number of days in a year. Is it right? Number of days in a year divided by credit purchases. See, you are taking how many days. First you will calculate the times. Okay, first you will calculate the times, and then you will convert into the year end payables. Is it right? How much is the year end payables? Year end payables are 230. Okay, this is the year end payables. Is it right? We have to know what is the number of payables, how much time we are taking to pay. Is that payables payment? How much time we are taking to pay out the payables? Is it right? How much time? How many times? See, what is the 365? Is it in 365 days? How much credit purchases is there? Credit purchases is 2 million. Is it right? Credit purchases is 2 million. Means if you are taking 2 millions, is it right? Where is the 1 million? Is it right? 365 divided by 2. Is it right? If you are taking 2 million, is it right? Purchases in a year, how many days will make it convertible to number of days? Means almost we are having a turnover of how many times? 2 times. Is it 2 million? 2 million per year. Is it right? Means 2 million per year into 365. How much you will get? We should have next time when ratio analysis comes, I will hold it. Okay, because you need lot of explanation. Directly we cannot go into the problem. That is the point. Okay, that is the point. We should that is I should. Okay, 1 minute. No, just hold it. Okay, just hold it. No, I don't want to make you confused. Okay, just hold it. When we do the ratio analysis, we will come. Is it? We have to give. I have to explain the concepts. Then only it will work. Okay. Otherwise it doesn't make. See, only we are getting stuck in ratio analysis. Okay, we are getting stuck in ratio analysis because without the background and explanation, we cannot push the things. Okay. So 1 minute. I will remove this. Okay. I will remove this completely. If you have the background, if you have understood previously, it will be easy. Is it right? If it is, we are without directly going to multiple choice is deadly. Is it right? Here also where we have done. Here also we have somewhere we have done now. We put question mark there. Where is that question mark? Where is the another question of yeah, here. Is it right? Here also. Here also question mark. Okay. Ratio analysis. Once we have done the lecture, then we will do. Okay. Then we will do. Fine? Okay, good. Nothing will happen. Is it okay?
Yes, it's okay.
Okay. Once we have done ratio analysis, we will do the questions on ratio analysis. On October, that's why we are finding difficult how to present it. Is it right? On October 1st, 2004, Pyramid acquired how much? 80% of 9 million equity shares. At the date of acquisition, the plant has fair value of 3 million and its excess is carrying amount. At the date of acquisition, it has a useful life of how much? 5 years. Pyramid policy is to value NCI at fair value at the date of acquisition. For this purpose, Square company shares has valued 350 each on that date. In the year end, Square reported a profit of how much? 8 million. Is it right? Square is a profit of how much? It is profit of 8 million. What they are asking us, what amount NCI in Square Limited with value with the financial position. Yeah, they are asking about the NCI value. Is it right? Now, how much is the P and how much is the Square parent company and the subsidiary company? Parent company is 80%. Subsidiary company is 20%. They acquired 80% of the 9 million shares. 80% of 9 million means how much? 80% of 9 million means 9 into 0.8, it comes to 77.2 million. 8 is it? 7.2 million here and 1.8 million shares. Okay, 20%. That's very important. Is that how much we have taken? We have talked about the NCI. Okay, we are talking about the only NCI. As simple as that. What is the value of the share? Value of the share. They have given the fair value. They have said that they are doing at the at the date of acquisition. Square company has an item of plant has a fair value of 3 million. At the date of acquisition, it has a value 5 years. The policy is to value, see, this is what it says. The policy to value NCI is at the fair value. Is it right? At the fair value. Fine. Very is a NCI. We have to focusing on only on NCI. Is it right? Is share in equity capital. Is that fair value? Is that fair value? When we take fair value, how much is there? Is it at 9 million times 0.20 times what is the value of the share? Fair value. The value of the share is how much? 3.5. Is it 3.5? How much it will come? 9 million shares into 0.2 into 3.5. Is it right? Into 3. It comes to how much? 6.3 million. Okay. Next. You have to take post acquisition profits. Add post acquisition profits. How much is the post-acquisition profits? Post-acquisition profits are 8 million. Is it right? From this 8 million, is it right? From this 8 million, what you have to do? See the things. You have post-acquisition profits. Is it right? Post-acquisition profits. How much is there? 8 million. Fine. Minus depreciation. Is it right? Minus depreciation. How much is the depreciation? Depreciation is 3 million divided by 5 years. Is it right? 3 million divided by 5 years. It comes to how much? 3 divided by 5. Is it right?
0.6.
How much? 0.6. 0.6. How much is there? 7.4 million. This is the post acquisition profits. Okay, this is the post acquisition profit. Now, is it a share? Now Now share of share of share of NCI in post acquisition profits. 7.2 million in times 0.20. 7.2 into 0.2. How much we'll get? No, it is not 7.2, 7.4. Is it 7.4 into 0.2? It comes to how?
1.48.
1.48 million.
48.
Add how much you'll get? 7.7.
7.78.
Answer is Is it clear?
Yes.
It is impairment, 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 it is on impairment, is it right? This section is on impairment. Two by 18, 15, 16, okay, fine. In accordance with IES 36, will what first we will see. Telepath has a year end of 30th September and owns an item of plant which is used to produce and package pharmaceuticals. The plant cost is 750, fine, and that there was estimated life of how many years? 5 years. A review of plant on after 3 years, is it right? It concluded that it will last for the 3.5 years, and that fair value is how much? 560. Telepath adopts a policy of revaluing non-current assets to their fair value, but does not make annual transfers from the revaluation surplus. Means they have the policy, but they will not have any annual, they will not transfer to annual revaluation surplus. Is it to represent the additional depreciation? I mean, revaluation means you have to calculate depreciation on the revaluation amount. Okay. On 30th September, it was informed a major customer it no longer placing orders on Telepath. As a result, Telepath has revised the estimates of net cash flows from the plant for the next 3 years, 220, 180, 200. Telepath cost of capital is how much? 10%. Definitely, they have given you the discount rates. Okay. Telepath owns Rilda of means now you see the thing. They have mixed the two questions. One, they are talking about the impairment in isolation. The second one is impairment with the parent and the subsidiary. Okay. A 100% subsidiary treated as a cash generating units. You understand, cash generated units, current assets value will remain same, goodwill and intangible assets will become zero, and whatever the balance is there, you have to allocate the balance among the different assets that exist. Okay, that's a small, I am giving you a flashback. There was an impairment of this impairment, we have to allocate the carrying amount. The assets are immediately before impairment is goodwill will become zero, is it? Goodwill will become zero. Factory buildings is there, is it? Property is there, plant is there, and current assets will remain same. Okay, current assets will not change. Any current assets will never change in terms of the cash generated units. Okay, fine. In accordance with IAS 36, impair which of the following assets, explain the impairment of asset and how to calculate its recoverable amount. They are asking you the formula, as simple as that. An asset is impaired when the carrying amount exceeds recoverable amount. Understand point? Carrying amount is carrying amount. See, what is the impairment? Impairment is carrying amount is carrying an asset when the carrying amount exceeds its recoverable amount. Is it right? If carrying amount is 10,000 and the recoverable amount is 90,000, is it right? 10,000 is minus. This is nothing but impairment. Is it? Exceeds a recoverable amount, and the recoverable amount is the higher of its fair value less cost of disposal. Less cost of disposal. What is the recoverable amount? Whenever we are talking in terms of recoverable amount is nothing but any disposal cost. Okay, any disposal cost we have to deduct, and then we will get the what is the net realizable value. This is the process of impairment. Okay, this is the process. That is the reason. First they are asking. See, you now you can have an view. First they will target us on the basics. Then they will ask you about the applications. Every multiple choice question section will be like this. They will focus on the basics and they will ask you the application. Fine. A asset is impaired when the recoverable amount exceeds carrying amount. No. See, recoverable amount is how much? Recoverable amount is 750. Carrying amount is how much? Carrying amount is 600. It is not a revaluation gain. Okay, it is nothing but what? It is nothing but a revaluation gain. Is it right? It is not a impairment. Is it right? It is not an impairment as such. Is it right? It is as an asset is impaired when the recoverable amount exceeds. No, if recoverable amount exceeds, it's not at all. Not the first rule is giving us a wrong idea. Is that the first rule gives us a wrong idea? Asset is impaired when the recoverable amount exceeds. Recoverable amount exceeds means what? You are getting profits. It is not an impairment. Is that? And asset is impaired when the carrying amount exceeds recoverable amount, and the recoverable amount is lower. It is not lower. It is a higher. It is a high. Means, see, when the recoverable amount is lower of fair value, is it assume this is the point, is it right? See, I will put the numbers for you, then only it will be more clarity. An asset is impaired when the carrying amount, assume carrying amount, is it? Assume carrying amount is how much? Carrying amount is 150. Okay. Recoverable amount, is it? Recoverable amount is how much? Recoverable amount exceeds, is it? It exceeds. Recoverable amount is less, is it? Recoverable amount is 130. Then definitely it is the first condition of what? It is the first condition of impairment. Fine. Now, what is the recoverable amount? This is where we have to be very specific. Recoverable amount is the lower of fair value. Is it? Recoverable amount is the lower of fair value. Means less cost of disposal. Recoverable amount is how much? Assume recoverable amount is 135. Is it? Cost of disposal. Cost of disposal is 5. Is it right? 130. Is it 130? Automatically what will happen? Definitely its value in use and value is in carrying amount is what? It's a huge difference. Is it right? Automatically what happens? This is the condition where it's not going to satisfy the recoverable amount is 130. How we are getting 130? We are making it sure, we are making it concerned that deducting from the cost of disposal. Is it right? Deducting 1 minute. We have to make sure here also. Is it right? If it in the first case, what happens? Assume in the first case same example. Okay. First case same example. Is that what we are doing? Here we are talking in terms of lower of the value, and here we are talking in terms of higher of the value. Is it? Here we are talking about the lower of the value. Here 150 is the carrying amount. Is it? 150 is the carrying amount. What is the rule? They say, which of the following explains impairment of an asset and how to calculate its recoverable amount? Is it? How to calculate its recoverable amount? Now, what happens here? What is the recoverable amount? Focus on the recoverable amount is nothing but the fair value minus cost of disposal. Okay, fair value minus cost of. Here we will take the recoverable amount. Is that? Here also we take the recoverable amount. Here we take the recoverable amount is how much? We'll take higher value. Is that? We'll take value of how much? We take value of 150. 150. Is it right? We take the value of cost of disposal is how much? Cost of disposal is 5. What is the fair value? What is the recoverable? Net recoverable amount is how much? Net recoverable amount is 145. Now what is the condition is, if you are having two conditions, two situations, is it? Which one you will take recoverable amount? Are we taking recoverable amount as 130 or we are taking the recoverable of 145? Definitely we will take the recoverable amount which is higher in value but not lesser in value, because if we take the recoverable amount higher in value of 145, the impairment loss will be how much? 5. If we take the recoverable amount of 150, the impairment loss will be more. Is that? The impairment loss will be more. We want to make sure that in which situation the impairment loss will be less. Is it? That is the reason an asset is impaired when the carrying amount exceeds the recoverable amount. Fine. And the recoverable amount is the higher of its fair value. Okay. higher of the fair value. We will not say it is the lesser of the fair value. If you say lesser of the fair value, impairment loss will be more. If it is higher of the fair value, the impairment loss will be less. Our objective is to make sure that impairment loss should be less, but not will be. Is it okay?
Yes, it's okay.
We'll do another one and we'll stop here. Okay? We'll just do another one and we'll stop here. This one will do. Period to consideration any. What is the carrying amount of telepath plant and balance of revaluation surplus? Is it right? Now what is the value of the plant? Is it right? What is the value of the plant? How much they have mentioned plant? They have mentioned how much? They have mentioned plant of what? They said that it is 560. Is it right? How much they have mentioned plant? 560. How much? See what happens. See the thing. The year end is how much? 30th September. And a review has been done on what? April 2003. Is it right? Now. Is it right? Now what happens? We have to know what they are asking. What is the question they are asking us? They are asking us what is the carrying amount prior to consideration. Is it right? What is the value of the plant? Value of the plant is how much? 560,000. Fine. Now, what we have to do? We have to calculate the depreciation. Is it right? Depreciation for how many months? Depreciation for 6 months. Is it right? Depreciation for 6 months. Means 560,000. How many years left? How many years are left? Years are 3.5 years. Is it right? 560,000 divided by 3.5 years times for how many months? 6 months. 6 by 12. How much you'll get? How much?
8,000. 8.
560 into divided by 3.5 into 6 divided by 12. Zero, 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 16 minus 8, 480,000. Is that 480,000? Fine. Next. What they are saying? Revaluation surplus. Is it? Revaluation surplus. How much is the revaluation surplus? They have mentioned a revaluation surplus of how much? Um, 750,000. It is for 360. It is valued as surplus. The annual transfer surplus represents depreciation. Customer no longer putting the things here. It is 1. This is 1, and it is how much? Next. Fine. Is it right? It comes to how much? Fine. Is it? Uh, 1 minute, 1 minute, 1 minute. The planned cost is how much? 750. Is it right? We are talking about revaluation surplus. Is it right? Planned cost is how much? 750. Is it right? Cost of plant is how much? Cost of plant is 750. Is it right? 750. And the year owns an item I will produce a pair. The plant cost on 1st October as on that date. The estimate life of 5 years. A review of the plant on 1st April. Okay, concluded. See the thing. Cost of the plant on this is happening when this is happening on 1st of October 2000. Okay. Next, 1st of April, is it right? 2003. October 2000, October 2001, October 2002. Is it right? It means from here to here, how many years have been over? 2.5 years. Is it right? 2.5 years. Fine. And at what this rate is at when they have purchased the plant, what is the life of the asset? The life of the asset is 5 years. Is it? The life of the asset is 5 years. Fine. 2.5. Now, okay, yeah, little bit we have seen. Now, fine. Okay, cost of the plant is 750. Okay, cost of the plant is 750. Is it right? Cost of the plant is 750. I will put little bit here. Okay, I will put little bit here. Cost of the plant is how much? Cost of the plant is 750. Okay, this is for how many years? 5 years. Less depreciation. Depreciation for how many years? 2.5 years. Why 2.5 years? October 10, 2000, 2002, 2001 to 2002. From 2002 October to April, how many? Those 3 months and these 3 months. 6 months. Is it right? Depreciation. How much will have? 750. 750 divided by 5 into 2.5 years. Is it right? It comes to how much? 375. Is right? It comes to how much? 375. This is the value of plant as on 1/4/2003. Is it right? Value of plant as on 1/4/2003. Is it right? Now, what they are asking? They are asking you a revaluation surplus. Is it? They are asking you a revaluation surplus. Is it right? Value of the plant as on 2003 is otherwise called as a carrying amount. Is it right? Otherwise called as a carrying amount. What is the revaluation surplus? Revaluation surplus is nothing but fair value of plant. Is it right? Fair value of plant. How much is the fair value? 1/4/2003. How much is the fair value? 560 minus carrying amount. Is it right? Minus carrying amount. Is it right? How much carrying amount? 375. Is it right? How much is the carrying amount? 375. 15 minus 7, 8. 4 minus 1, 185. This is the revaluation surplus. This is the revaluation surplus. How much is there? 480 is this one. Revaluation surplus is this one. Answer is this one. Is it okay?
Yes.
Okay. Now I will send you this immediately. I will send you this question, this file. Okay. You can keep, you can, if you want, you can revise it, and tomorrow morning when you are meeting now, we'll start with 17 and we'll continue. Okay. We'll start with 17 and we will continue. It's
Inshallah.
inshallah. Okay. You will have an idea how the exam questions will be there. Then we will do section C also. I think we have to do section C. It makes sense. In section C, see the thing. They are asking about what? See the thing. They are asking about, say, a very comprehensive. They are talking about the retained earnings. They are talking about the preparation of financial position, balance sheet, and they are asking about the operating and investing activities only. How much they have mentioned for cash flow statement? 3 marks. Is it? For cash flow statement they mention how many marks? 3 marks. And subsequently what is there? We have the ratio analysis. Is it right? They have given for ratio analysis. This is what it says. No, they have talking about consolidated financial statements. They are talking, no, see they mention, see, gearing ratios, and they are talking in terms of analysis. Okay, they are talking about analysis. How much they have made the gearing ratio? 12 marks. 5 marks for ratio calculations and 5 marks for the analysis. Is it right? So just we will hold for ratio analysis. Other things we don't have any issue. Is it? Other things, because we have done the other things repeatedly, we know the concepts. Is it right? We don't know the concept. That is the reason we are working it very smoothly. Is that only ratio analysis we got stuck it up, because we have not done. Is it right? That is the reason. Even if I explain now, I cannot